Did you know out of all the Canadians who are saving their money somehow, 47% of them actually keeping those money in cash? Let's go. Hello everyone, Alex is here and this video is gonna be crazy. And I really hope you're actually sitting down or better even laying down because today we're gonna be comparing ETFs and mutual funds.
Round one, fight.
And this is a very important topic because 45% of Canadians who are actually investing their money using mutual funds. That's a lot of luxury cars and pretty good houses for their fund managers. And compared to ETFs, only 12% of those Canadians who invest their money using ETFs, which is pretty cool. And I'm really proud about those guys who quit their mutual funds or haven't even started with mutual funds in the first place, because you can save up a lot, up to $1 million in fees going with ETFs. We will be doing some financial nerd math today, and we'll get to the bottom of how these mutual funds and ETFs are different and why and what you need to pick for your investments. And to answer the question right away, picking the mutual fund with a fee of 2.3% versus ETF with the same stocks, with the same portfolio underneath, with a fee of 0.5% can actually reduce your portfolio by 48% after 30 years of investments. Moreover, a lot of mutual funds have fees that are actually higher than dividend yields. What? Really think about it. What? It would be exactly the same as some random person knocks on your door and says, all right, I can manage your entire current dividend portfolio and keep all your dividends to myself. What would you do? You would probably call the cops. That would be the right thing to do. This is exactly what is happening in mutual funds. All the fees you're paying to maintain and manage all these mutual funds, they don't make any sense. You can pick ETFs, which will guarantee you the returns and will save you 90% in fees alone. So why all this happening and how the mutual funds are different from ETFs? So typically mutual funds are run by a professional manager who attempts to beat the market by buying, selling stocks, and relying on their own expertise. And this is called active management, which translates at the end of the day into the higher cost for investors. ETFs, on the other hand, can go both directions, actively managed and passively managed. And actively managed ETFs are pretty much similar to what the mutual funds are doing, except for the fees. The average fee for the actively managed ETFs is around 0.7%, compared to the mutual fund where it is 2.3%. The other type of ETFs is passively managed. These ones are not managed and they're not trying to beat the market or anything like that. They're basically tracking some pre-selected index like S&P 500 or NASDAQ top 100 companies. And the average fee for the passively managed ETFs is around 0.2%. But those fees can go all the way down to 0.03% for some of these passively managed ETFs. And while the actively managed ETFs or mutual funds can outperform the passively managed ETFs on the short term, long-term results actually tell a completely different story. Between the higher expense ratios, fees, and unlikelihood of beating the market over and over again, over the long-term period, passively managed ETFs actually outperforms actively managed funds or mutual funds. And what is this fees or expense ratios? An expense ratio indicates how much money investors pay each year as a percentage of money invested to own this fund. Passively managed ETFs are relatively inexpensive. The expense ratio can go down all the way to 0.03%, which means that investors pay only 30 cents per every $1,000 invested. The expense ratio for mutual fund ranges from 1%, unreal to find, all the way to 4%. So the bigger your portfolio, the lower the fee you're gonna pay, if you can get to that big portfolio number with such fees in the first place. And the average expense ratio for mutual funds in Canada would be around 2.3%. And the first thing to notice here is that 2.3% fee doesn't sound like much, but it actually adds up pretty quickly over the long-term period. It's actually a compound growth, but with fees. Let's drill down what are the fees actually need to be paid for mutual funds versus ETFs. The ETF part is easy. There's only one fee you need to pay, the expense ratio or MER, which is included into the price of the ETF, so you're not going to see this fee appearing as a separate transaction on your account. For mutual funds, this is a completely different story. there are a lot of fees that are associated with them. And the first one is the same as for ETFs, is an expense ratio or MER. The second one is the sales commission. And this one goes into 3 different types of sales commissions. The first one is a front-end load, which is basically the fee that you pay for your initial investment. This is going to be around 5%. The next one is the back-end load fee. This is basically a fee that you need to pay when you exit the fund or when you decide to sell your investments. It ranges all the way from 5 to 7%, and the fee is lower the longer you stay with mutual fund. And the third type is the low load sales charge. And this one applies to some of the newer mutual fund where you would not be required to pay the front load fee or the back end load fee if you stick around for more than 2 years. And the third fee that applies to mutual funds is the trailing commissions or trailer fees. And these fees usually embedded into your management expense ratio, but basically represents a fee that is paid annually by investment funds to financial advisors for their services. This one is around 1%, and it also is taken from your investments. And the fourth fee for the mutual fund is the short-term trading fee. This one is around 2%. Is it applied to your investments if you decide to sell them within 7 days after purchasing them? So yeah, there are a lot of fees associated with mutual funds. Now let's do some nerd math and compare mutual funds and ETFs over the long-term period. How much fee you're going to be paying and what is going to be the end result of our portfolio. And we're going to be comparing a mutual fund with a fee of 2.2% versus a specialized ETF with a fee of 0.55%, which is XDV by iShares. The ETF fee, as you can see, is on the higher side. That is just so you can see how much you can save even going with this high fee ETFs. Now doing a quick math, 2.2% minus 0.55%, we end up with 1.65% of extra fees. And now looking at the overall picture where you have 2 different investments, one is the ETF with a fee of 0.55% and the other one the mutual fund with a fee of 2.2%. Now say that your initial investment has $10,000 and you plan to contribute $5,000 a year for the next 40 years. And say we have an average return of 7.25%, that is actually return of the XDV ETF over the long-term period. Now, in terms of the fees, the ETF will cost you at the end of the day around $171,000, and your mutual fund investment is going to cost you around $546,000. That is crazy. And this is the fees, right? So the end result, the end balance of your portfolio after 40 years for your ETF, excluding the fees, is going to be $1,120,000. For your mutual fund, though, your final balance after 40 years of consistent investments is going to be $715,000. So you are losing a lot with fees, and there is no reason why you need to do that. The ETFs are super simple to manage. There are ETFs where you need only a single ETF for your entire portfolio. I have a video where I talk about those. Or you can build even lower fee ETF portfolio where you need to have only 3 ETFs in your portfolio. I also talk about those in one of my recent videos, so you can check it out that. And also the most crazy one is that you can build the lowest fee ETF portfolio, which consists of 5 different ETFs and can give you 0.09% expense ratio for your entire portfolio. And that's also pretty crazy. And I have a video about those too, so check it out there. Because if you are curious, and you probably are, if you go with the lowest fee ETF portfolio, then you'll end up paying only $29,000 in fees after 40 years of investments. And your final balance is going to be $1,270,000. This is even better, way better if you compare it to the other ETF portfolio we just talked about. So it's up to you what you're going to do next and how you're going to build your investment profile. But I really encourage you to look at all this for your portfolio and see where you are right now and how many years you have still for your investments and how you want to proceed. With all that, thank you for watching. Don't forget to smash that like button really hard, subscribe to my channel, hit the bell, and I'll see you around. Keep building your investments. Cheers, bye.